A year ago, building artificial intelligence was a blank check operation. Investors poured cash into projects based on the promise of the technology alone, assuming future profits would naturally follow. Today, that limitless optimism has met a strict economic reality. To understand why the rules are changing, we have to look at the broader economy. Asset managers like T. Rowe Price have identified specific forces squeezing the market right now, creating an environment that punishes aggressive, unoptimized spending. This chart illustrates the two forces dictating investor sentiment. We have a descending market momentum trendline representing slowing economic growth, intersecting right here with an ascending inflation curve. This creates a severe squeeze on corporate budgets. That intersection point represents persistent cost bottlenecks. Raw materials, energy, and labor are all becoming more expensive, while the overall momentum to out-earn those costs is fading. Investors are reacting by replacing their previous enthusiasm with extreme caution. This puts the tech sector on a collision course. Training and running frontier-scale AI models requires massive amounts of capital and power. You have an expensive technology trying to expand inside an economy that is aggressively tightening its belt. The era of growth at any cost is over. For the AI industry to survive the squeeze without exhausting its capital, it must abandon its original playbook and develop a highly disciplined economic model. We are already seeing this strategic pivot at the top of the industry. Brett Taylor, chairman of OpenAI, recently signaled that leaders are changing how they measure success in artificial intelligence. He pointed to a concept called tokenomics. Instead of a race to build models with the highest number of parameters, which cost billions of dollars to maintain, developers are focusing on extracting maximum utility from leaner, more targeted systems. This diagram illustrates token efficiency. Rather than forcing a massive, high-resource compute pathway to solve every simple prompt, a streamlined, low-resource pathway lowers the computational cost required to complete a single task. When you optimize that cost per task, the competitive landscape changes. It allows frontier labs to serve millions of users without requiring exponential increases in server space, making scalability the primary objective. Winning the AI race no longer requires the largest digital brain. It requires the most economically efficient thought process. Software efficiency reaches its limit at the hardware level. To support these new tokenomics, engineers are rebuilding the global server footprint from the rack up. At the recent SIGGRAPH keynote, NVIDIA highlighted the massive leaps required in rendering and data center compute power just to keep up with current demands. The software is pushing the physical hardware to its limit. This chart shows the semiconductor supply chain, and it reveals the actual physical bottleneck. Based on recent earnings from suppliers like Micron and Rambus, we are seeing a surge in demand for AI storage, specifically DDR5 memory, which acts as a choke point for the data centers operating above it. When we factor in the rise of wafer-scale computing systems from companies like Cerebras, which require massive contiguous blocks of processing power, this supply chain is stretched even thinner. While software dictates the economic rules of this market, hardware supply chains determine the actual speed of the AI revolution. We can see how the end users of AI are reacting to these intense infrastructure costs by looking at the enterprise and consumer layers. Companies like Duolingo and Accenture are adjusting their strategies. In recent earnings calls, management teams de-emphasized pure top-line revenue growth to focus on operating leverage and keeping profit margins strictly disciplined. We see the same behavior in the financial sector. Institutions like FedBank and ICICI Prudential are enforcing strict internal cost controls to ensure their tech investments deliver steady returns. Corporate buyers are no longer adopting AI blindly. They are demanding measurable returns on investment and margin discipline before they agree to expand their technology footprint. These combined pressures on software, hardware, and corporate margins signal that the market is moving into a maturation phase. The initial wave of broad experimentation is being replaced by a period of selective strength. Investors are now rewarding only the companies that can prove their long-term viability under strict financial scrutiny. A company must master token efficiency, scalable hardware, and pricing power. Only operators in this overlapping center capture market share. Lacking any of these three pillars risks being squeezed out by macroeconomic pressures. Execution quality and margin discipline have replaced technological hype as the primary metrics for success in the tech sector. The final metric of this cycle is financial sustainability. The advantage rests with the companies that can lower the cost of intelligence until AI is affordable enough to be used everywhere.